Fine. So then basically understand what is this particular topic that we are doing, or when do we need to do this process. Now, in a business, we need a lot of machinery, equipments, uh, plant, factory equipments, large machines, and various types of capital assets, basically, which will help us in the production process. Now, in all scenarios, it is not possible for the business, or rather feasible for the business, to purchase the assets outright. So then, in that scenario, there is an option available to the businesses to avail this method of purchasing an asset, which is
Okay.
called as hire purchase
Higher
method.
purchase.
Right. So then this is basically for us what we call as an EMI. This particular method is also a sort of an EMI approach for companies who want to purchase multi crore assets, or
Okay.
multi crore proper like equipments, etc., machinery,
Okay.
etc., which they cannot buy outright. So they basically buy it at a installment or a
Yeah.
EMI of sorts. Like we buy
Okay.
smaller items on EMI, but if a business is buying something using a periodic payment situation, then
Yeah.
that is basically this process of hire purchase and installment method.
Yeah. Okay.
So so in this method, basically what happens is that the entire value of the asset is broken down or divided into various equal parts, and it is paid by the business every year as installment, and which
Okay.
also includes a certain amount of percentage of interest within it. Fine.
Yeah.
So the concept is clear, right? So this is the base idea of it, and a few things that we need to, few terms and terminologies that we need to remember here. First of all, we need to know who is a higher vendor. Basically, just a second, I'll just make a higher. Right. So in higher purchase, the first thing that we need to know is the higher vendor, basically higher vendor. Fine. Who is an higher vendor? Higher vendor is basically the seller, right? Who is selling us the particular asset, and
Yeah.
we will be considered as the buyers, basically, right? We are the
Higher
buyers.
purchasers.
Yeah, we are buyers. We are
Okay.
the buyers. Basically, higher purchase. It's not called higher purchase because the reason being that we are the ones, so we don't call ourselves in third person like that. So
Okay.
in that sense, we basically call ourselves like we don't call ourselves like that.
Yeah.
Cool. So
Yeah.
we won't need a third person situation in this condition. Okay, fine. So this is the first thing. Next will be the installment. So what is an installment? Installment is uh, basically a periodic payment. Periodic payment. Fine. It is a periodic payment being made uh, in order to basically take that asset. Right. This is the
Yeah.
second thing. The third thing is that we when we take when we take the asset on hire purchase, the possession of the asset, possession possession of the asset is transferred, and not the ownership. Fine. So this is basically the next point that we need to remember. This
Okay.
particular thing means that only the physical possession of the asset gets transferred in the transaction. The ownership is not transferred. The rights, basically, the rights are not transferred.
Okay, okay, okay.
Fine. So the rights, when do the rights get transferred? The rights only get transferred when the
After the whole
last,
payment is done.
yeah, when the last installment is paid.
Okay.
Fine. So this is basically the scenario, that when the last installment gets paid, that is when the
Uh,
um, that is when
ownership
the
rights are
ownership,
being
yeah, the ownership of the asset gets transferred. Cool. So
transferred to you.
yeah, so
Yeah.
that's pretty much the idea of this possession of the asset is transferred, not the ownership. Now, furthermore, two more things that we need to remember, that in this installment, like this is a point that we need to remember about installment itself, that installment has two parts in it. The installment has two parts in it: the principal, or the basically the cost of the asset, obviously, um, the cost of the asset, and the interest, because we are delaying the payment, right? So if we are delaying the payment, then we will have to pay a
Yeah.
certain amount of interest on it, right? So that is also
Okay.
included in that, yeah, included in that transaction. Cool. So yeah, that's pretty
Okay.
much one more thing that we need to remember. Furthermore, there is a point that we need to remember related to this point, that the asset can be repossessed. A repossession.
Okay.
Repossession. When will this happen? When any installment payment is missed. Fine. So when any installment payment is missed, the asset can be repossessed again. Is it okay? Do you understand this
Okay.
part?
Yeah.
So do
Yeah.
remember these points. These are some of the basic points that we need to remember. I summarize them. That hire purchase is a method where we as a company can buy a asset which is worth a lot of money.
Yeah.
If we don't want to buy it outright, we can buy it under hire purchase method, where we have to pay an installment, or yearly installment or semi-annually installment. And in this, we buy the asset from somebody called as the hire vendor, who is basically the seller. And in this, only the possession is transferred. The ownership remains with the hire vendor, and it only gets transferred when we pay the last installment. Right now, installment
Yeah.
has two
Yeah.
parts in it: the principal, which is also the cost of the asset, and the interest added on to it because of the delay in the payment. And there is a concept of repossession also, meaning that if we are not paying any of the installments, then the vendor can take back the assets, or ask for the assets to be returned back. Fine. So
Okay.
that's pretty much the idea. Okay.
Yeah. Okay.
Is it okay? Some of the basics are here. Further, let's read. Let's take a look at the further parts. Just a second.
Okay.
Yeah. So then, this is basically uh, so yeah. So methods of accounting: we can keep the records of accounts in the hire purchaser's book or the hire vendor's book. Hire purchaser basically is us, and the hire vendor is basically the seller. We have already seen this. Now, in this, the special features of a hire purchase, I already told you that the possession of the goods to the hire purchaser immediately after the transfer of possession happens, right?
Yeah.
But the ownership only passes when the last installment is paid. Okay, so do read these 2 points simultaneously once. That the first point says that the possession of the goods transfers immediately, but the ownership only transfers when the last installment is paid.
Okay.
Right? Fine. There is a concept of down payment also. What is the down payment? It means that a lump sum payment which is made at the beginning and during the signing of the asset. Like the signing of the agreement or the hire purchase agreement, right?
Yeah.
So the similar to a down payment on a car or a property, right? So this is pretty
Yeah.
much the same logic here. Now terms and conditions,
Okay.
again, mostly most of it I have already told you that the hire vendor, hire purchaser, cash price is basically the cost price of the thing, right? And that's pretty much it.
Okay.
So,
Yeah.
fine. So this is the basics. Let's now take a look at some of the calculation part. So, as I told you just now, that there is an element of interest included in that, mm, in the what we can call in the process. So then you will be asked to figure out that interest amount and to calculate the cost amount. So how
Okay.
will you do that? You will have to basically do a bit of back calculation. Now, how
Yep.
does that back calculation work? Let's take a look at this. This question says
Okay.
Asha purchased the truck on hire purchase system. As per the terms, he is required
Yeah.
to pay 70,000 down payment, 50,000 at the end of the first year, 49 at the end of the second year, and 55 at the end of the third year. Interest is charged at 10%. Now you are required to
Okay.
calculate the cash price and the interest paid with each installment. Now understand, if we take this question, let's quickly take this question onto our whiteboard and try to understand this. Now this particular question
Okay.
is saying that understand what are the various parts of the question. The first part is that there is a down payment of 70,000, meaning day zero, at day zero, we are paying 70,000. Meaning that in this there is no interest, obviously, because the payment is
Okay.
being made
Yeah.
today. If there is any payment of money being made today on a loan, if I'm, let's say, taking a loan and I'm making a payment on that loan today, there is no interest on it, right?
Okay.
Isn't it? If you take a loan today and
Yeah.
paid back today, will there be any interest charged?
No.
So that's pretty much the
No,
idea
they
that
won't be.
on, no, there
Yeah.
will be no interest, as you said. So then on this there is no interest. So the 70,000 is a full, like a cost amount itself, there is no interest on that. But this 53,000
Okay.
has a interest included in it, isn't it? Because the on day 365, on the first year, year one year one we are paying 53,000, meaning that there is 1 year interest, 1 year interest on this,
Okay.
isn't it? Now
Yeah.
49,000 is paid next. So meaning that on 40 year two there is a payment of 49,000, meaning that there is a interest, 2 year interest in it. Fine.
Yes.
And then the third one, 55,000, year three, 55,000, meaning that there is 3 year interest on this. Cool. Now we just have to
Mm.
back calculate and calculate the value of the item. Is it okay? Like
Yeah.
you
Yeah.
understand what we have to do, right? Now we have to learn how to do this
Yeah.
basically. Now tell me, since you have a bit of maths background, can you tell me like anything that you would do here in order to back calculate? Because this is
So
maths. Yeah.
yeah.
So
So
then,
the third year will become the first thing you calculate.
haha. The third year is the
Yeah.
first one that you will calculate. Very nice. So very good.
Yeah.
So the starting point will be this year 3. Very nice. So how will we
Yeah.
calculate this? Because this is the final installment payment. So then if this is the final installment payment, then we can assume that my cost price in that year was X, on which I calculated the 10% interest, and I added it to this X value, and I got 55,000. This installment
Yep.
value includes cost and interest, right?
Yeah. Yeah.
Isn't it? The cost is
Yes.
assumed as X, the final remaining principal value, and this is the interest percentage. Yes,
Yes.
in the last installment, whatever is remaining on that, I will allow a 10% interest, right? In the last year, whatever due has remained, on that a 10% interest will be charged. We have assumed that the value is X, isn't it? So
Yeah.
then on X
Then,
there will be a
yeah.
10% interest. Is it
Yes.
okay? So let's say I took a loan of 10,000. First year I paid 2,000. Second year I paid 2,000. Third year I paid 2,000. Fourth year I paid 2,000. Now in the fifth year, how much is remaining? In the fifth year, only 2,000 is remaining. Yes.
Yeah.
If I took a loan, let's assume just for explanation, if I took a loan of 10,000, first year I paid back 2,000, second year 2,000, third year also
Okay.
2,000, fourth year also 2,000, meaning that in the fifth year, how much will be left? 2,000, right?
2000.
So then I
Yeah.
have
2000. Yeah.
over the years, I have paid back some money, and in the end, I am paying 55,000. Now this 55,000 is my installment, meaning in this 55,000, I have some interest and cost included in it. I just told you, right, that the installment has some cost and some interest included in it. So
Yeah.
then in all of these, this and this, there is a cost element and there is an interest element. Yes.
Yeah.
Now in this
Yes. Yes. Yes.
55,000 also, there is a cost element and an interest element.
Yes.
So I am assuming the cost to be X, the interest to be 10% of
Yeah.
X,
Yeah.
because the interest is charged. Obviously, interest will be charged on the principal, remaining outstanding principal. No, however much your loan is pending, on that you will charge the interest, right?
Yes.
Cool.
Yes.
Okay, so that's pretty much the idea
Yeah.
here.
Cool.
So then,
Yeah.
if we just calculate this, we can cancel this out. So and take an LCM, so it will become X plus 10X by 10 is equal to 55,000.
Yes.
I took an LCM. I'll transfer this to the other side. Let's say, for example, it will become 11X is equal to 55,000 into 10, and
Yeah.
X would become lastly 55,000. I think I put an extra zero here, no?
Yeah. There's already 4 zeros there.
Uh, into 10 whole divided by 11. 11
uh,
5s are
let's
55,
put in extra zero.
5,000.
Yeah.
So then
Yeah. Yeah.
X would be 50,000. So what is this
Yeah.
X? This X is
The cost.
nothing other than the principal value, principal,
Yeah.
or the cost, the last remaining cost. This is the last remaining cost in this. We are not done yet. This is just one part of it. So in the year 3, our cost is 50,000, and therefore the interest in the last year is
Uh,
interest
is
in
5,000.
year 3. Yes, perfect. Year 3 is equal to 5,000. Done. This is the first part done. Now, if we go back, go up, that would mean that if we add it up, so now outstanding for the previous year. So next part will be previous year outstanding. Previous
Year outstanding.
year outstanding balance. How will we calculate? We will just add 50,000, the 50
249,000.
exactly, plus the 49,000, and that will give me the outstanding of the previous year, right? Which will
Yeah.
be equal to 50, 40, 90, 9,000. Yes. Now within this 99,000, there is a cost element in it plus an interest element in it, very similar to the
Yeah.
last situation also. Yes. So
Yes.
then here also we will repeat that same process that we did, that x into 10 by 100
By 100 plus
plus
X is equal
is
to
equal
99,000.
99,000. That will basically lead to the same situation. X is equal to 99,000 into 10 by 11. 11 nines are 99, so 9,000, meaning 90,000. X is equal to 90,000, which is equal to the cost.
Cost and 9,000 is the installment.
9,000 is the interest.
Sorry, interest.
Year 2 interest is 9,000. Nice. Done. So now next part, again same, repeat the same process. Outstanding for the previous year, outstanding. Do this part by yourself. Do this part by yourself.
Yeah.
What will we do now? We'll again go back from here to here. So then outstanding in the previous year would be
53,000
50,
plus 9,000.
53.
Yes. Was it
No.
not 53?
Oh, right. Yeah.
Yeah.
Not the 9,000, the 90,000.
So, yeah, sorry, 90,000.
The cost plus the thing, installment.
Yeah. No,
So
the installment is 9,000.
no, installment is 49,000.
What? Sorry?
The installment is 49,000, right? Year 2
Yeah.
installment was 49,000.
Sorry, the interest. Sorry. I got it.
Yeah. So the cost and this would get added up.
Yeah.
So then how much will we get?
So we will get
1,43,000
yeah.
outstanding for that last, like last from the back, but first from the starting.
Yeah.
So we will have 143, right?
Okay. Yes.
So then now do this and tell me how much, what will we do? So this
This
143 also has,
cost and
some part is cost and some part is interest in it.
interest. Yes.
So then we will again do that same thing. 10 x by 100 plus x is equal to 1,43,000.
Yes.
Yes. Which would mean that x is x is equal to 1,43,000 into 11 by 10. Sorry, my bad.
Yeah.
I reversed it into 10 by 11
11. Yeah.
into 10 by 11, which will give me, if I cancel this, 11 ones are 11, 11 threes are 33, 13,000, which will give me 1,30,000
Yep.
as the principal value of this first installment outstanding. Right.
So yeah, the interest would be 13,000.
Interest would be
13,000.
13,000. So then the interest here is interest in year 1 is equal to how much?
13,000.
13.
Is it not? Yes. No, sorry. No, it is 130,000. 1,43,000 minus 13,000. 1,30,000.
Should be. Yes, it's 13,000. Yeah.
Yeah.
140, and I was looking at the wrong value. This and this basically, yeah. These two values. So done. So then now we have found the all the 3 years interest. The last thing that is
Yeah.
left, therefore, cost of the asset will be equal to how much? The cost of the asset will be, right now outstanding cost is 130, and plus the down payment that we had made at the beginning, which was this. Then the outstanding at the beginning, also known as the cost of, this is also called outstanding at the beginning. Outstanding at the beginning. So will be 130 plus the down payment of 70,000 equal to 2 lakh. So the cost of the asset is 2 lakh. Is it okay?
Yeah.
Any doubts on
Yeah.
this?
No.
Fine. So do take a
But
look.
yeah.
Do take a quick look at this process. We are just starting from here, back calculating it every step and reaching here. And we are calculating, segregating the interest and the cost value in every step. So here also we segregated the cost and the interest using X value. In the second one also we did the same thing. In the third one also we did the same thing. We didn't need to do the same at the end because there is no interest in the down payment. So we got the outstanding at the beginning. Cool.
Yeah.